All right, let's get right into it. Today, we are pulling back the curtain on something that pretty much affects all of us, but that most of us don't really understand. How do banks actually decide who gets a loan? I mean, really think about it. You hand over all your paperwork, you cross your fingers, and you wait. But what's going on in their heads? What's the secret checklist they're running through? Well, that's exactly what we're going to break down today.
You see, banking isn't just about spreadsheets and numbers. At its heart, it's this incredibly high-stakes balancing act. Banks are lending out other people's money. Yeah, that's right, your money, my money, and they have to do it in a way that's both profitable for them and super, super safe for us. The law itself actually defines banking with these two key functions, taking in our deposits and then lending or investing that money. And right there, that's the central challenge, isn't it? They have a fundamental duty to give you your money back when you want it, which means they have to be incredibly careful about who they lend it out to in the first place. So here's the game plan for this explainer. We're going to start with that balancing act, then dig into the 6 core principles that guide every single lending decision. After that, we'll talk about your rights as a borrower, introduce you to the different types of loan applicants, and finally, we'll open up the bank's financial toolkit.
Okay, let's get to the main event. You know, banks don't just wing it or go with a gut feeling. They operate on a really strict framework. You could almost call it their secret recipe for making good lending decisions.
And I'm not exaggerating when I say every decision. These 6 principles are the absolute foundation of how a bank manages risk. They're what protect our money as depositors, and honestly, they're what keep the whole financial system humming along. Let's look at them one by one.
First step, and this is the big one, safety. It is priority number 1, always. Why? Because remember, the money they're lending isn't actually theirs, it's ours. So before anything else, a bank has to be rock solid convinced that the borrower can and will pay that loan back. Next, you've got liquidity. This is just a fancy way of saying that banks need to have cash ready to go. You might want to withdraw your savings at any time, right? So the loans they make have to be paid back on time every time. It's all about keeping the cash flowing so they can meet their promises to you, the depositor. Of course, banks are businesses, so profitability has to be on the list. They charge interest to cover their own costs, pay you interest on your deposits, and hopefully make a little profit. But here's the crucial part. Profitability can never come at the expense of safety. A responsible bank is not going to chase a risky, high-interest loan if it puts the original money in jeopardy. Then there's the principle of purpose. Banks really want to see that a loan is being used for something productive, something that generates new income. Think about it. A loan for new machinery for a factory helps that factory make more stuff to sell. That new income is what ultimately pays back the loan. The loan basically pays for itself. This one is a classic. It's the old don't put all your eggs in one basket rule. Banks call it diversification. They make sure to spread down loans across tons of different industries, different parts of the country, and different types of people. That way, if one sector, say the auto industry, has a bad year, it doesn't sink the whole ship. And last but not least, we have security. This is what most of us call collateral, an asset the bank can claim if things go south. But here's the inside scoop. A good bank is much more interested in the strength of your business plan. The collateral is just the backup plan. The real security for them is a project that's likely to succeed. Okay, so we've looked inside the bank's mind. Now let's flip the script and talk about you. Because there are rules in place to make sure you're treated fairly. It's called the Fair Practices Code, and you can think of it as your borrower's Bill of Rights. And this code isn't just a friendly suggestion, it's a set of mandatory rules for banks. It's all about making the lending process transparent and fair, and it puts very specific duties on the bank from the moment you even think about applying. So let's run through what they have to do. First, total transparency. The application form has to spell out all the fees and costs, no surprises. Second, they have to acknowledge they got your application and give you a timeline for a decision. Third, communication has to be quick and clear. And fourth, and this one is huge, if you're a small borrower and they reject your loan, they can't just say no. They have to tell you why, in writing. That's real power because it gives you the info you need to fix your application and try again somewhere else. So who are all these people asking for loans anyway? It's not just regular folks like you and me. Banks deal with a whole cast of characters, a wide range of different legal entities, and each one plays by slightly different rules. I mean, the list is long. You've got individuals, of course, but you've also got partnerships, big limited companies, trusts, and even small community-based groups. The point is, a bank has to know exactly who they're dealing with, because lending to a huge corporation is a whole different ballgame than lending to a local book club.
Now, here's where things get really interesting, especially when we look at the difference between a regular partnership and a limited liability partnership, or LLP. In a traditional partnership, if your partner racks up a huge debt, guess what? You're both fully on the hook for it. But in an LLP, you're protected from the fallout of another partner's mistakes. That's a massive difference in personal risk, and it's why LLPs have become so popular.
All right, so we've met the who in the world of borrowing. Now let's talk about the what. What are all these different people and companies actually asking for? Well, banks have a whole toolkit of products, but it all really boils down to two main categories. And this chart here, it kind of shows the two worlds of credit. It might look a little complicated at first glance, but it's all based on one simple split, right at the top. Is the credit fund-based or non-fund-based? Once you get that, everything else makes sense. And trust me, the difference is actually super simple. Here's the simple breakdown. Fund-based credit is exactly what it sounds like. The bank gives you actual funds, actual money. Think of a car loan or a business line of credit. Non-fund-based is different. No cash changes hands up front. Instead, the bank gives you a promise, like a guarantee that you'll finish a big construction project. The bank only has to pay up if you don't deliver on your promise.
So when you boil it all down, what is bank lending? It's really not just a simple transaction. It's a whole system, a complex relationship built on what you could call calculated trust. It's guided by those principles of safety we talked about, and it's regulated by rules designed to ensure fairness.
And hopefully, by understanding this system, from the bank's secret recipe to your own Bill of Rights, the whole process feels a lot less mysterious. You're no longer just a passive applicant. You're an informed player. So the real question is, now that you know the rules of the game, how will you approach your next big financial move?